Do you want to start a thriving real estate career but don't know where and how to start? Do you want to become a successful realtor or investor but lack the required knowledge and skills? Gear yourself up with the best and actionable advice here on the Real Estate Rundown. Tune in as Shannon Robnett talks with industry veterans about all kinds of asset classes, market trends, challenges, management techniques, and success stories. Listen to informative discussions with valuable tips that will serve as the foundation for your incredible real estate venture. Now, here's your host, Shannon Robnett.
Hey, everybody. Welcome back to another episode of the Real Estate Rundown. You know, there's a lot of things that we're dealing with right now, and there's a lot of turmoil in the market. And I thought that was really an appropriate place for our next guest to join us, because there's a lot of things that a lot of people think they know, but they don't really understand, or they don't know, and they're not utilizing some of what I think are the best tax strategies on the planet. And so I want to bring on Jason DeBono with NuView and have him talk more about what he's doing in self-directed IRAs and how we can make that a more prevalent part of your investing portfolio. And with that, how you can get better returns because you're doing it in a tax-efficient way. So my guest today is Jason DeBono. Welcome to the show, Jason. It's great to have you on.
Hey, Shannon. Good to be here. Thanks for having me.
You know, Jason, we had the opportunity to do a podcast a couple months ago, and we talked before the show for quite a bit. But tell my audience a little bit about where you're at, what you're doing, where you come from. Kind of give us your 3-minute overview of your resume.
Sure. So I am, in fact, to this week of recording, this is my 18th anniversary with NuView. Company is celebrating its 20th year. So I started in year 2. And, you know, I look back 18 years ago and the self-directed IRA business was just so different. We do exactly what we do today as we did then, but, you know, the exposure, the understanding, the fact that people are using self-directed IRAs as a tool. But yeah, 18 years ago, I started, you know, in sales and marketing, giving presentations, helping people understand how it worked, what it was, why they needed it, what kind of tool it was, the tax incentives, all of the things that listeners may be moderately familiar with. And yeah, we've grown since then. We had 65 billion of assets under custody when I started, and we're about 2.2 billion today. So been a fun ride, gotten to see and live vicariously through, you know, our clients and kind of see trends and, you know, investment strategies and structures. And yeah, it's been a pretty cool process.
So let's take this from the basic elementary level. What is an IRA? What are the different types that there are? And what is the difference between an IRA and a self-directed IRA?
Yeah. So if you kind of look at an IRA at a glance, an IRA is a retirement account really for people to save outside of 401ks. That's really why Congress created IRAs back in the 70s. So they wanted to make sure that if you had a way to put money away in a tax advantaged vehicle to save for retirement. So the very simple premise is the IRS will give you a tax benefit in some way, shape, or form, as long as you commit not to touch the money till you're 59 and a half. That's the trade-off. But an IRA is designed for you to save for retirement. The difference between a self-directed account and a, you know, we refer to as a non-self-directed retirement account is the fact that you can buy whatever the IRS allows, including things like real estate. So what makes us unique, or what sets us apart from the Schwab or Fidelities of the world, is that our clients are buying real estate, investing in syndications, doing private loans with their retirement money. So they get all the tax benefits, and they get to keep that money invested into assets that they know and understand.
So when we talk about self-directed IRAs, you know, there's some legality there because it's your money, but it's not really your money, right? I mean, it's yours, but like you mentioned earlier, the IRS said, okay, we'll let you have it tax deferred or tax free if you agree not to touch it. What are some of the stipulations? I want to buy, you know, I want to buy real estate, or I want to buy, you know, gold collectible coins, or I want to do some of these things. What is the process that I got to go through to get from my IRA that's sitting over at Schwab to something that I can really get into real estate with and do something that I want?
Yeah. So if you think about, you know, what an IRA is, a tax advantaged investment vehicle, right? It's earmarked for retirement, but it's a tax advantaged investment vehicle. That's what they are today to all of us. The IRS is concerned that if it's tax advantage, they put a fence around that because they don't want people violating the rules or integrity of that tax. That's what they're after, right? So what they're saying is, Shannon, you've got a retirement account. You said you won't touch it till 59 and a half, and we said we won't tax you, right? Great
Right.
trade-off. But furthermore, they say, okay, Shannon, in order to maintain that tax benefit, your investments all have to be at an arm's length. So when you invest, you have to invest passively and you have to invest really with unrelated parties. There's some opportunity there, but for the most part, it's got to be unrelated parties. And the reason for that is if my IRA could buy real estate and I could buy it from whomever I wanted, what would stop me from buying a piece of real estate in my IRA that I personally own today? Well, I would certainly sell it to my IRA at a discount so I get a nice tax loss on my tax return, right? And now
Right.
my IRA has this property it paid 50 cents on the dollar for that's 100% tax free. And you could see how easy it would be to commit tax fraud. So the rules are really centered around tax integrity, and everything has to be completely arm's length and passive for it to be permissible as a general rule inside an IRA.
It's funny, they want arm's length transactions for the citizens, but the senators don't seem to have to deal with that.
Yeah,
So
well, they're on a different retirement program all together,
exactly,
ironically enough.
exactly. So the reality is, yeah, if I wanted to buy a property, I'm not going to be entitled on it.
That's right. Because you're not the buyer, right? Your IRA is the buyer, and it's important that people kind of think about this. The IRS wants to know from a tax standpoint, what was the behavior? Well, if I just put Jason on it and then decide later if it was me or my IRA, obviously the winners, right, are all going to go in my IRA and the dogs are all going to go personally. So the IRS
Right.
says, you got to declare it from day one. So if you want to own this in your name, Shannon, personally, and treat it like a personal asset, Shannon's on the title. If you want to own this in your IRA and keep it shielded from your tax return and shield any taxes per your IRA, then it's got to go in Shannon's IRA's name. And so they're very clear and adamant about that.
So once we've done that, what are the differences as far as how um, things are treated? I bought a house, a rental property in my IRA. I've got a property management company that's managing it. What happens to all the rents? What is the protocol with all of that?
So much like a dividend stock, right? Dividends in an IRA go back to the IRA because the IRA owns the stock, issues a dividend. And as a result, the money goes back. It's no different in a retirement account for real estate. If my IRA buys a piece of property, my IRA collects all the income, pays all the expenses, all flows in and out of my retirement account. Now, the property manager is facilitating that, but everything's going in and out of the account.
Okay. So it all seems pretty simple, but what are some of the real tax savings or the tax implications? I mean, so I bought this property for $300,000 and it's been in my IRA and it's been a rental property for 15 years and now I want to sell it. Do I have to make you guys sell it? Do you guys hire the real estate agent? What happens in that particular portion of the transaction?
So mechanically, a self-directed account is driven completely by the account holder, right? So if you decided what house to buy, you decided and negotiated how much to pay for it, you decide how long to hold it, you decide if you want to rent it, who to rent it to, and for how much, right? You are the sole decision maker. When it comes to selling the asset, you're still the sole decision maker. You decide how much to sell it for. You decide who you sell it to. If you want to use a realtor, you decide who's going to be that listing agent. So the beauty is you're not relying on NuView, right, or me for anything other than the custody and safekeeping of the account. I'm here to help keep your IRA an IRA. As far as all the investment discretion and decisions, the beauty is all of that goes right back to you. So we're not involved in the decision making process. We're just involved in the execution process.
And that's what makes it a really simple, seamless process because all I'm doing is directing you as I would an employee or a contractor that, hey, do this, and then you do it.
Yep.
What are some of the things, the misconceptions that people have when it comes to self-directed IRAs and what they can do with it or how difficult it is? I mean, what are the main things that you're seeing in your marketplace as barriers to people using them more?
Well, I think the first one is just knowledge and understanding, right? People, they've been told they got to use their retirement money to buy stocks, bonds, and mutual funds, set it and forget it. And it'll just work out in their favor when they retire. And I think if you look at the wealthiest of wealthy or just whatever line you want to draw in the sand of what you would consider someone wealthy, 90% of the people above that line's portfolios are going to be real estate based. So
Right.
the biggest thing is knowledge and experience. The second thing is there's a lot of people that aren't willing to go make investments. They need the market. They need mutual funds because they don't want to go do the underwriting. I mean, Shannon, we've known each other for a while, and you know, you're looking at 100 deals before you do a deal, right?
Right.
People don't want to do that. They just want to pull out a menu of stocks and bonds and mutual funds and type in a couple ticker symbols. The last thing is there is a lot of misconception that it's complex or that there's a lot of rules. And yes, there are rules. The IRS has to govern this stuff because of the tax benefits, right? They have to fence that tax opportunity. But the rules are so minimal, and the only time that we find clients that run up against the rules is because they want to do something that's prohibited, and that's when they kind of throw their hands in the air and say, "Well, why would I do this?" I'll give you a quick, if I can take just a minute, I'll give you a quick story. I had a client years ago. A guy called me and he said, "Hey, I want to buy property in my IRA. I found this rental property and I think it's a great deal. I can buy it, way below market and it's right by a university and it'll rent out no problem." I'm like, great. He's like, "So I can go buy that. I can sell my stocks and go buy that in my IRA." And I said, "Yes, that's something that you can do." And he said, "And when my daughter gets to college, she can live in the place." And I said, "Unfortunately, everything you want to do is good, but your daughter can't live because there's no way for you to get a fair market rent from your daughter. That's not arm's length." And he paused and he said, "Well, then why would I do this?"
I knew that's where
And
you're going. I knew that's where you're going. People will self-sabotage over the littlest things, right? I mean, this
right,
thing is saving thousands of dollars a year. It's making money. It's in a tax sheltered environment. And over what, $600 a month in rent for 4 years, he blows the whole deal up, right?
you got it.
Yeah. But, I heard you say that people just aren't educated enough or they just want the easy button. What you just described doesn't sound like it's a difficult experience going through this and converting it to a self-directed IRA and buying real estate. Do you think it's just overall general laziness that people just want the easy button on everything and that they're not willing to put in a little bit more effort that it comes with real estate?
Yeah, no, I hate to say yes, because I think that's painting a pretty broad brushstroke, but having done this for 18 years, I talk to countless people that say, "This is incredible. It's amazing. I wish I knew about this sooner," but they'll never actually pull the trigger. So,
Yeah.
those are, yeah, unfortunately, those are folks that just want the easy button.
So, would you say that most of your clients at NuView, most people that are involved with self-directed IRAs, are they involved in alternative investments outside the stock market?
Yeah, 99% of the assets we hold is all outside of the stock market.
And that's simply because they found a better way that provides better returns than the market. They have some control over it. They can buy and sell as they want. They can, they have a lot more control, but it's also they're invested in real assets. I mean, you've got stocks and bonds that's a piece of paper, or you've got real estate and other alternative investments. I mean, could you buy a classic car that was a showroom quality car? Could you buy that in your self-directed IRA?
So the only assets that are prohibited, and the quick answer is no. The only assets that are prohibited are life insurance and collectibles. And to
Okay.
answer your question specifically, the issue is if you think about that collectible car, its value is whatever the highest bidder is willing to pay. And so when you think about it from a taxation standpoint, if there were ever a tax liability to be attached to that car, how would the IRS ever be able to either assess a tax or defend against it? Whereas if there was a taxable event against a piece of property, right, there's a fair market value that's attached to that. You could argue maybe it's a little higher, a little lower, but there is a way to get to a fair market value, whether it be through a cap rate or whether it be through price per square foot. You don't have that luxury in things like, any sort of collectible. So anything numismatic is prohibited.
So, but you could invest in startup companies or other things like that because inevitably at that point you're part of the seed round or you're part of a stock option, pre-IPO, those kinds of things. But you would be able to take advantage of things that wouldn't necessarily be offered on the NASDAQ or the New York Stock Exchange.
Yeah. Yeah. Private equity is about a third of our clients' portfolio. It's a
Okay.
huge market. Yeah. You can invest in your friend's, landscaping business, so you can invest into the next, tech unicorn. Hopefully it's the latter, but
Right.
that's the beauty of private equity. It's whatever you think has legs, and sometimes it does, and you get paid off really well, and sometimes it doesn't, and maybe it doesn't perform as well.
Sure. And the reality is if I experience losses in my IRA, those really don't translate to my real life, right? I mean, because it's a tax protected thing. Is that something that if I buy into the tech unicorn and it really is just a donkey with a cone on his head and I wind up losing money in it, does that, can I carry forward that loss like I would on my normal books and use that when I go to take money out after retirement?
No, and that's something that you want to be very aware of, because you don't have the downside, but you also don't have the penalty on the upside. So if you buy something personally and you lose money, yes, you carry that forward, and somewhere you get some redemption for a bad investment.
Right.
The contrary is when you make money in your personal name, Uncle Sam's going to come asking for a piece of it, some way, shape, or form. In an IRA, you give up the losses because you've got no tax to apply them against. So, if you're winning in your IRA more often than you're losing, you could take $1 in a Roth IRA, invest it, and make 1 billion and pay zero tax. That's the beauty. But you can't invest 1 billion that becomes $1 and write off that $909 million loss, unfortunately.
Right. This is why Peter Thiel was such a genius when he did what he did with PayPal, right?
Nope.
Put that into an IRA. So give me some of the reasons why someone would want to buy real estate through their IRA rather than hold it personally.
So, the answer to that question is in the eye of the beholder. And I say that because when it comes to taxes, the taxes are personal. So you got 2 points of comparison. So the first thing is, if I wanted to invest, let's say, a $200,000 property, if the only place my money that I have 200 grand or accessibility to buy that property is my IRA, then I need to compare that property to what my IRA is currently doing. So if I can buy the real estate and think I can make 20%, and in order to do so, I got to sell a stock that's making me 5%, that's an easy decision. But if I have the same 200 grand sitting in a bank account as well, and I can either write a check and buy it personally or write a check and buy it in my IRA, the real question becomes, what's the asset? What do you intend to do with it? And then what bucket does it fit better in? If you're going to do anything short term, those always fit better in an IRA, because short term has the highest capital gains tax rate. And so anything in an IRA is going to automatically trump that. So that's beneficial. If you're going to buy it and hold it long term, then you may consider your personal account for it, because you can take some depreciation and some write offs, and you can kick some of the tax gain down into long term capital gains. When it's all said and done, good assets always have a home in an IRA, because you'll never be upset to buy a good asset 100% tax free, ever.
Right. Right. So then, people they use this vehicle and everybody, always says, yeah, I'm investing in my IRA for retirement. And then, what happens when we hit retirement? If we've used a Roth IRA and we've invested, we've been tax free on the inside on going into it, right? With a Roth, and it's grown. We put in, all our money all these years, and now we have $5 million in there. The question always comes up of, okay, well, if it's inside my IRA, I can't have access to any of it. I can't use any of it for personal items, so I can't even borrow against it. What is typically happening when you come to that and now you're at retirement age and you're taking money out? What does the IRS say about it at that point?
Once you hit 59 and a half, you're free to withdraw your account. A Roth IRA is tax free. You can take whatever you want, whenever you want after 59, 100% tax free. Now, part of that is tax planning and tax strategy, but that's what you're working towards. I mean, yes, you can't use it, you can't borrow against it, you can't live in the properties, you can't leverage, for your own personal benefit. You can leverage inside the account, but that's only up until 59 and a half. After 59 and a half, it basically the chains, if you will, that lock that money down come off. So yeah, you can withdraw it at any point. Now, if it were me and it were my Roth IRA, that's the last money I want to withdraw. Because if you turn 60 and you're old enough to withdraw, you don't have to. You can keep growing that money 100% tax free. So I'd much rather burn my personal accounts to zero before I started taking out of my tax free accounts for expenditures. But that's a little bit of tax planning. But yeah, it's yours. I mean, it's the beauty. You worked up until 60, 59 and a half for that freedom.
So you've also got, you've got a traditional IRA, right? Where you're putting money in that versus a Roth. Explain that to us real quick so we can understand what we're looking at here.
Yeah, so anything that is not Roth is considered pre-tax money. That means that you get a tax deduction to put it into your account today, and then you pay tax when you withdraw it. So easiest way to analogize that is, do you want to pay tax on the seed or do you want to pay tax on the crop?
Right.
And when people ask me that, my first question is, how good a farmer are you?
Right.
If you're going to put money into a mutual fund and hope it earns you 5 to 7% for the next 20 years, you may be better off with a tax benefit today and kick the can down the road to pay tax later. If you're going to invest and go out and seek deals and stay educated, they won't always be winners, but if you can get to that double digit average return, then you're almost always going to want to be in a Roth because you can prepay the tax. I mean, think about this, and this is something that I'm a huge advocate for the Roth. Shannon, if I came to you today and said, Shannon, write me $100,000 check today, and you won't have to file a tax return for 2023. Now, your decision-making process is very simple. Will I pay the IRS more than 100 grand or will I not? If the answer is yes, you would trip over yourself to get me 100 grand. Why? Because you had a predefined, predetermined amount that you could pay tax on, and you can make that, then you knew what it would take to win the game. The IRS is doing that every single year with your IRA with a Roth. They're saying, Shannon, pay me 4 grand and you can take 20 grand of your pre-tax IRA and move it to a Roth, right? And now you got to ask yourself, can I earn more money on that 20 grand over the next 20 years than the 4 grand I'm paying in tax today? And when you
Right.
start really boiling it down that way, 9 out of 10 times, if you're a decent investor, pay the tax today. You'll
Right.
never have a better opportunity than tax-free growth.
But just like the first analogy about the gentleman who failed to buy the house because his daughter couldn't live there in a couple years, a lot of people get so hung up on paying taxes now, right? That they'll
Yep.
do anything to alleviate that pressure. They don't want to pay it now. I'll pay it later. We'll invest it. We'll just go with the traditional. What do you think outside of the self-directed world? And you may not know this, but what do you think the popularity split is between the traditional and a Roth, just because of people's mindset around I can't pay taxes. I don't want to pay taxes. So I'm going to load my traditional so I don't have to claim that as income now. What do you think that split is?
So I don't know too good a degree of certainty, but I do know a few years back, it was the first year ever that Roth contributions had surpassed traditional contributions.
See, that would be exactly what I would have guessed because people just have this that it's not a phobia, it's not a fear, it's just a loathing of, I don't want to pay taxes, so I will do anything that I can. And I struggled with that for a long time because I kept thinking, I don't want to pay it now, not realizing that yes, now is when you're going to pay it and it sucks, but it's going to offset because you've got 25 years between where you're at and where you're going for it to grow.
Yeah, well, I love talking about taxes. First question I ask people, I'll ask the audience, to answer, as they're listening to this, and that is, do you like paying taxes? And if your answer is no, I would say you're a liar or you don't understand what paying taxes is because I didn't ask if you like where the money goes. I didn't ask if you
Right.
think,
Right.
these folks in Washington are smart or not. That's not the question. I asked if you like paying taxes because if I ask the next question, which is, do you like making money? Everybody's answer is yes.
Right.
Well, if you like making money, then you must like paying taxes and you better learn to embrace it. Now,
Right.
obviously, I'm on the side of deferral and elimination of taxes, right? Because
Yeah.
that's important. But it all starts with if I had to choose pay taxes, or make money or not pay taxes, I'm going with make money.
Yeah. Yeah. No, and that's I think where a lot of people break down that distinction. They don't like the activity of paying taxes, but they like the activity of having funds around, right? When you really look at that and go, well, you really can't have one without the other. And to a large degree, you can. We do a lot with tax strategists. We make sure
Yep.
that our tax bill is absolutely as low as possible. We use things like a Roth IRA. We use things like, deferred sales trust. We do a lot of different things because we want to ensure that we have the ability to create what we need to and be able to mitigate that tax as much as we can, like but then there comes the point of the smart money says you pay it now, you invest it now, you harvest it later at a much higher coefficient, and you've done that in a tax efficient way. So when people think about, how they're going to do that, it's amazing to me the psychology of no, I hate paying taxes, or no, my daughter can't live there, so I'm not going to do it. And, looking at if the guy had invested before COVID, it wouldn't matter if his daughter was living there, just not rent that room or something. But, you really see how psychology plays into that and how, I wouldn't say that we're taught, but we're just kind of ingrained with the fact that nobody wants to pay them, but there's the right time and the wrong time to pay them. There's the right things to do with pre-tax dollars and there's the wrong things to do with pre-tax dollars. And I think a lot of people miss that connection. When we talk about, the reasons why people would want to invest in real estate, with their IRA, you did a pretty good job of explaining that. And what are some of the most common things that you're seeing people invest with self-directed IRAs?
Yeah. So, we really are business, we got about $2 billion of assets spread over thousands of clients. We get a pretty good handle, on kind of what the market's doing. We're seeing it really spaced out into four categories, right? One is real estate. Real estate is, what we would consider deeded or titled real estate assets. So this could be, and man, I'll tell you one thing, Shannon, just to slide over for a second. I didn't realize how many different things people could buy to make money.
Nice.
I just over the last 18 years, we have clients that own burial plots, we have clients that own mineral rights underwater where they grow clams, and we have clients that own, the boat slips. And I mean, obviously, you've got your traditional real estate, right? Single family, multifamily, that sort of thing. But that's deeded real estate, domestic, international. They own title of some kind to a piece or parcel of property. The second category is on the lending side, and this has been the fastest growing category since I've been here, and we're going to see another trend, I think, over the next few years where this will grow as well. But this is private debt, and it's private debt of all different shapes and sizes. This is, things like private or hard money to, individual mortgages to business lines of credit to convertible debt. We've seen just every type of debt you could imagine.
Tax liens?
Tax liens we'd put in the other category, which
Okay.
is
You'll get to that in a minute.
yeah, we'll get to that, but it is kind of funny. It almost is a form of debt, ironically enough. The third is private equity, and private equity really is growing the fastest because that's where a lot of these syndicated real estate deals technically are considered private equity because your ownership is not real estate, it's into a fund or an asset. What I love about private equity is it's a way for people to capitalize on investments through the strength and power of others, whether it be I'm investing in Shannon's business, I'm investing in a syndication, right? It's kind of like buying a stock, right? You buy, you may go buy JP Morgan, right? Because of Jamie Dimon and his
Right.
ability, right? Or you mentioned
Right.
Peter Thiel earlier. And so you can invest a little bit around leadership. So private equity is growing. And then the fourth category is that other, this would be your cryptocurrencies, tax liens, which we're starting to see more and more of lately, tax deeds, tax liens, that sort of thing, all fall into that other camp.
So when you're looking at that, you've got to, I love that, now it's making a lot more sense to me what you said earlier in the show where, you're talking about, it's easier to talk about what you can't buy, right? The things you can't do because the genre is really wide. Whose responsibility is it to make sure that we're buying something in that genre? Is it my responsibility because I'm directing you, or is it your responsibility because you're the custodian?
So it's about 99-1, right? And it's 99-1 where the onus is to you as the customer. And the only reason I say one is because there are certain things that we see that we will reject, but it's not our job. When you open an account with any self-directed custodian, you will declare, acknowledge, and indemnify the custodian for any and all wrongdoing. And the reason for that is not because we want to hide behind a barrage of legal language, is because I have no idea the totality of your deal. So, for example, going back to that guy that couldn't rent the house out to his daughter, right? Well, if he buys a property and the names don't line up and it's an unrelated party, how would we ever know? If he's renting it to his daughter but not telling us, how would we ever know? If his daughter is married and has a different last name, or maybe, how would we ever know? So it all fits into that camp of, we don't have any responsibility because we simply can't. I can't drive around. We have thousands of properties that our clients own. I can't drive around with a clipboard knocking on the door and checking IDs of, who's residing in the property. So It's, with great power comes great responsibility. And, that's something that I've told many people over the years. I don't think that either this is the right tool or product for you, or if it is, we're not the right custodian because there are too many people that want to do it the right way. And if your goal and objective is to skirt this, and I'm not talking about toeing the line, I'm a big fan of toeing the lines.
Mhm.
But if your goal is to just tell me how to get around this, tell me how to get around this, tell me how to get around this, we're not going to be a great fit because you're likely going to stub your toe and we don't want any part of it.
Right. So we still, as the director of the IRA, essentially the self-directed part, we still have that responsibility to vet the investment, make sure it is what it is, make sure that everything's right. Then the syndicator or whoever, private equity firm, sends in the paperwork. You guys fill out the paperwork as it was us, but we still bear that responsibility. In doing that, it really puts the onus right where it should be, right? I mean, we're the ones that are directing, right? So we need to be responsible for that, and we need to understand that. But when we talk about how your guys are protected from that liability, you know, you guys have that 1% duty that says, hey, you know what? You're trying to buy a collectible car. We can't let you do that, right? So there is, but you guys also, you offer a lot of education on that. I mean, if someone wants to know more about how they can learn more about this, how are they going to go about that with you and your firm?
Yeah, I mean, you nailed education, right? That's exactly what people need. It's like driving a car, and if you drive a car, you're responsible to know the rules of the road and the laws. And if you drive in a different state, California, for example, you can't use a cell phone, right? So there's some things no one's job that the person that rents you the car, right, or the toll booth operator when you enter into the state, it's not their job, right?
Right.
You have to take that responsibility. It's no different in a self-directed account. We can educate you and we can point you to all the areas of code and we can give you all the necessary interpretations, rules, guidance, structure, understanding. But at the end of the day, you are the one pulling the trigger and it is your job to ensure that you're staying within those confines. But education is key. We offer free education, unlimited quantities of it. And I mean, we've got thousands of videos on our YouTube channel. So all of those represent ways that I won't, ignorance is not an excuse. Ignorance means the good news about ignorance, it's curable, right? Now,
Right.
stupidity is not,
Right. Yeah.
unfortunately, but ignorance is. And we live in a day and age where, you can literally with a cell phone, you have every single thing you want, need, and desire at your disposal from an educational standpoint. We're running out of excuses to say, I just didn't know.
Right. And for those of you that are listening in California, Jason, as a Floridian, did not say you can't use a cell phone as in you're unable, but the law doesn't allow you. Just so I just want to put that so before we get some hate mail on that, right, Jason? Oh, those guys in California that can't use a cell phone. You can, but again, you're not supposed to. So just what
That's right. And asked me how I know that. I learned that the hard way. Now, we more recently have some laws here in Florida on cell phone usage, but yeah, I got pulled over in California for I was talking on a cell phone and I was holding it up to my ear years ago. And apparently I was required to have a Bluetooth device. So
right.
learned that one the hard way.
Yeah, I also learned that lesson now that we're in confessional, but I think we should stop there, Jason, on the confessionals. That's probably way more than our audience wants to know. But Jason, tell us how people can get in touch with you and learn more about what you're doing at NuView, get these videos that you're talking about. Where can they find you?
Best ways, just to start on our website, it's NuViewTrust.com, spelled with a U, NuView Trust. From there, you can get to our YouTube channel or any of our socials. There's a tremendous amount of content. We too host a podcast, and Shannon's been kind enough to be a guest on there. So there's all kinds of great content, spread out amongst a bunch of different mediums, but all of that's available and able to get connected through the website.
Awesome. Well, Jason, I appreciate you being on the rundown and helping us understand what is the benefit of a self-directed. It's sad to see that so few people actually use self-directed when it's such an awesome tax tool and one that we recommend all the time. And guys, if you're having trouble spelling NuView, just look at the sign behind Jason. It's pretty clear. If you still can't spell it, we probably ought to talk about that analogy that Jason talked about between stupidity and ignorance. But anyway, guys, thanks for being on the Real Estate Rundown, checking us out. If you like this, be sure and subscribe. You can find us at shannonrobnett.com for more information. And Jason, once again, thanks for being a guest.
Hey, Shannon, thanks for having me.
That's a wrap for today's episode of the Real Estate Rundown. Let these newfound strategies pave the way to start a successful career or a profound rebranding. If you loved everything you have heard, listen to more conversations at www.shannonrobnett.com. And be sure to leave a rating, share it with your friends, and subscribe. Until the next episode.